Hi, it's Helen Tarrant. Welcome to another episode of Commercial Property Roadshow with Helen Tarrant. Today I'm actually going to cover off the 3 commercial property types you should be getting into in 2021, and of course depending on your risk. So if you're getting prepared for 2021, you really should start now. If you haven't got any information regarding commercial property and you want to get into commercial property and you want to understand commercial property, really check us out at helentarrant.com, but also really get some education, get some understanding of commercial property so that you can be ready to launch in 2021, because there's going to be heaps of opportunities in the market. But one of the 3 top properties you should be getting into, and depending on your risk, is what we were going to talk about today. So number 1, most people think and have mindsets around allied health, medical is going to be the big thing because we just had the pandemic, and there's still things happening through our system, and there's a demand for medical. Yes, we have an aging population, and there's absolutely a demand for medical. The only problem with medical and allied health is that the returns and the yield is really, really low. So how do you combat that? The thing is to look at getting into maybe a warehouse type property. So if you want something that's ultra secure, so you are someone who is very risk averse, someone who wants to sit at your desk and be a passive investor and looking for a very secure commercial investment to get into. So the first type of investment you will get into is probably a small warehouse property. So a property maybe between anywhere from $500,000 to $700,000. It's going to be part of a strata complex, a small strata complex. And we're not looking for one that has got 30, 40, 50 tilt slab warehouses. We're maybe looking at one that only has 12 or 80, so less than 20 warehouses, and the tenants are all complementary type tenants. So they're all trade, or they're all specialists like perform. So they could be even something with a dance school, a martial arts, community center, or if they might do business to consumer, so they might have a warehouse with a showroom. They might even do online shops, and then customers come to them. There might be a mechanic, there might be a specialist mechanic, all of those things. So a warehouse type of property with probably a mezzanine floor, roller door access, and allow you to have a little office space is probably the most versatile and secure type of warehouse properties you can get. Now, depending on the tenant and the location of the property, your yields can change anywhere from 5% if you're in Sydney to anywhere from 7.5% when you're in fringe Brisbane area. So the yield really depends on where you want to choose to buy. So if you can tolerate a little bit of risk and something not to buy in your backyard, then perhaps somewhere in Brisbane around that 7% mark would be ideal for you. So you're getting some cash flow, and you're getting that security in the tenant and the versatility in the premise. So that actually itself is for someone who's totally risk averse. They just want someone, a tenant in there, and the tenant's on a 3 or 5 year lease. So the tenant just chugs along and they've got a tenant history. So that compares really, really well to a medical or allied health tenant, and you're getting a higher return as well. So if you are risk averse and you're looking at getting into commercial property, that's the number 1 top 1 thing to get into. Of course, in that space, you're not going to have a lot of negotiation room. You're going to have to accept what the yield is in the market. So sometimes it may have to be a little bit less than 7%, but you're really buying the security of the tenant, the versatility of the property type, and you're buying the location of the property as well, so that in the long term it will be a more of a longer hold strategy as well. But what happens if you're medium risk averse? So you're not totally risk averse. You've had some experience in property. So you've done some residential, maybe stratas, maybe subdivisions, maybe you've done a house and land build, and you want to get into commercial property, but you need something just with a little bit more than just your plain vanilla set and forget. So what do you do there? What is a medium risk type of property? So the first thing about medium risk is to look at areas. Rather than sticking to your metro areas, is to go to fringe areas. So if you're in Brisbane, maybe 30-40 k's out of the CBD. In Sydney, we're talking about your Central Coast and areas like Newcastle and further and beyond, and maybe even regional centres like Wagga, Albury, Wodonga. If you're in Victoria, you can Geelong Way, areas like that, or even the corridors towards moving towards New South Wales, areas like that as well. So the larger regional towns can definitely be good for you. Areas like Gympie and Bundaberg really be great for you, because it allows you to have a little bit more risk, but in a large town where it's insulated because it's got multi-drivers in there, which means that it has multiple drivers of economy. So that means it's got some of them will have military, some will have education, some of them will have health, some will have tourism. So it's all blended in together, agriculture, maybe a little bit of mining, so that you actually get a blend, and there's demand for that actual property if you lose a tenant. So that means that if you need to replace a tenant, it's not going to be so hard to find. And typically these places have anywhere from 50,000 to 150,000 in population. So that's somewhere, if you're a little bit more medium risk, you want to look there, because you're going to get higher returns. You're going to get higher returns. You still can look for a more secure tenant. So you could look for a tenant that is that could be in a freestanding office space, so it has a lower level and an upper level, or perhaps you could look for a tenant that is in a freestanding space on its own with land at the back, or you could be looking for a strata property that may have, as long as it's got maybe a professional type tenant in there. So you might have an accountant, a lawyer, a solicitor, financial planners, or you may have an IT company. Any of those properties in a regional area, even if they're not freestanding, when I say freestanding, like a building on its own, depending on what you can afford, and they're just a strata office or retail space being used as professional space, then that will still work. One of the great properties that we recently got from one of our clients is a property in Toowoomba. It's a large population, over 100,000 people there. They're a fruit distributor. It's about a 7.5% yield. Free, on its own premise. So it's on a 400 square meter block, about 300 or so lettable area, and it's got a fruit distributor who's using it partially, the property as an office space, and then a bit of distribution center at the back so the trucks can come and go, and it's about $530,000. So that's quite affordable, and it is really for medium risk, because you're out of the main metro areas, but you're still in a really stable regional area with a really stable tenant as well on a 6-year lease. So if you're medium risk, that's what you're looking for, and that's kind of the market to break into that regional center market, so regional metro market. And with that regional metro market, you can then have a bit more variety of tenant, and that will allow you in the future to capitalize a little bit of growth, or maybe do some amendments to the property. So it has a little kick into the future as well. And it gives you more cash flow into your pocket as well. So if you're medium risk, that's what I would target. If you're high risk, so you're not risk averse, you actually want to go for it. You want to find the property that is distressed. You want to find the property that is, underperforming. You want the property that's going to give you the highest growth, or you can manufacture the equity out of it. Then I would be putting myself into still into a large regional area, or maybe even fringe regional areas. So the area itself, the population is important, the transitness of the demographic is important, but what I'm looking for is a different type and profile of a property. So instead of your allied health, medical type tenants or professional tenants, I'm actually looking for more of a multi-tenant property, but the thing is, the tenant itself might be on short leases. So the short leases doesn't bother me. So that's where the risk comes in. If you're not risk averse at all, a short lease is ideal for you. That's when you can get the highest return, you can negotiate the hardest, and you're looking for a property that is not beautiful. So it's a rundown property, and the property itself is, you might have a tenant that's maybe, a training center that's been there for the last 5 years, but now on month to month. It may be that the tenant was even a boutique clothing store, that you need to swap out that tenant and put someone like a hairdresser in. It may be a beauty or a hairdresser that needs to be expanded, and you need to maybe amalgamate 2 or 3 shops for them. It could be a property that that the tenant's underperforming, and that you need to actually move them on and then bring someone else in. Or you might be getting a property that is actually going to be vacant in 6 months time. So at the moment you're accumulating cash flow, you're going to get this property at really, really high returns, but you're going to accumulate cash flow. So after the 6 months, you go in there, do the refurbishment, put a new tenant in there on a longer lease, and get the uplift from that property. So that's where I would be putting in, if you are not risk averse at all, is looking still at large regional centres and areas, but maybe even going a little bit fringe in the regional areas, but looking at a property that is underperforming, looking at a property that's not beautiful, look at a property that needs to be tidied up, looking at ones that has a short tenancy. So the classic one that I have is recently we looked at a property up in Townsville. It's a large regional town. It had a tenant that had been there for 20 years, and it had just left in September, so the vendor was doing some works on it, doing the floors and redoing the ceilings, and just to try to attract another tenant in there. And then downstairs it's got two smaller tenants. One is a security trainings company, the other one is a rentals company. So they do like furniture rentals and white goods rentals and stuff. So the tenants downstairs are, one is a month by month, they haven't renewed their lease, so someone coming in, you can definitely negotiate on that. The other one only takes year by year leases. Now the key is to get a tenant upstairs, and that's all part of negotiations. That the vendor wants 1.25 for something like this, but in my opinion that property is probably a $1 million property, because by the time you put in a tenant upstairs, you negotiate leases with the tenants downstairs, you could probably get it to a 10-11% yield in a market where it's a multi-tenanted property will sell for 8 and 8.5%. You're getting your uplift. You're basically building the $200,000 equity into your property from doing that, and it may take you 6 months to do that. And that's what essentially, if you're not risk averse, that's what you're going to go for, because you're going to end up at the end of it with cash flow as well as growth as well. So this way, you get to see that along the line, when you're investing in regional or in metro areas, you can start as little as 4% return yield all the way to 14%. Where you want to sit is really where your risk profile is and how risk averse you are. So the more passive you want to be and the more risk averse you are, the more towards the lower end of the return. So you buy a set and forget, it's in a strata, you don't have to worry about it, the cash flow just comes in. If you're on the other end and you're not risk averse at all and you're adventurous, you want to go out there and you've done developments before in residential, you've taken rundown houses, you've done a knockdown and rebuild, and you've done subdivisions and all of these things, and you want to do something more, then a property like that in towns will be ideal for you, because it gets you to tweak the property, you get the $200,000 in the back end in terms of the equity, plus you get a 10% cash flow, which it's going to give you way more cash flow than a 7% yielding property. So it's all about balancing out and understanding where you sit so that you can get into the deals. And really, in 2021, it's never been a better time to buy commercial property, but it's never been a better time to actually understand yourself, your own strategies, and how that correlates to a property, and the three types of properties you could get into in 2021 and really capitalize on that. So want to find out more, want a personalized strategy, go to the contact us page at helentarrant.com, and I look forward to helping you in the future. Thank you and bye for now.